Hello traders, this is Brian Benson. I'm the options trading specialist here at the Technical Traders, and I wanted to go through an option premium selling strategy, very much like a covered call. And even as a covered call, it does not work particularly well with some very expensive stocks, but we've had a couple of big name stock splits as of late. Nvidia with a 10-for-1, Chipotle with a 50-to-1 split, and pretty soon we're going to have one in Broadcom. AVGO is going to be a 10-to-1 split. So post-split, of course, it doesn't change a thing about the fundamentals of the company, but it certainly makes the shares and many of our options premium selling strategies much more accessible after the split. So I'll start here with Broadcom, AVGO. And of course, if we were to just sell covered calls on this, we would have to buy 100 shares of stock. And at the current price of about $16.60 a share, that means that to do just one covered call contract on Broadcom, we would be looking at $166,000 of stock to get into this trade. And once we own that 100 shares, then we could sell call premium against those shares. There's a somewhat popular alternative to covered calls where instead of buying the shares, we instead would buy an in-the-money call that's longer dated, further out in time. In this case, maybe we'd go out till December or so, and we could sell call premium 30, 45 days at a time over and over again and collect call premium that way. Technically, this is a call diagonal spread. And so just to give a little example of that, and again, we're looking at Broadcom pre-split. Say we wanted to sell the July out of the money calls here, maybe the 1670 strike. We could sell those for about $52, collect about $5,200 in premium. But we would either need to own the shares, we said that was $166,000, or we would have to go out to a longer month and buy a lower strike. Say we bought the 1660 out here in December. So let's just go in between the bid and the ask here and say that this cost $190, and that's the price for that 1660 call. So even at $190, well, we still have to multiply that times 100, and we would have $19,000 tied up just to buy one contract of that 1660. So still a pricey trade when we're using the call option as a substitute for owning the shares. It's certainly cheaper to own the option, but this is all rather capital intensive because we're talking about a stock which is very expensive, $1,660 a share. So if we switch to looking at Nvidia, which has gone through its 10-to-1 split and had been trading up around $1,200 a share, right at post-split, it was trading $120, $125 a share, something like that. And then all of a sudden, our call diagonal spread becomes much more viable. And to give you an example of that, we went out to December and we bought the 115 call for $18.48. And at the same time, we turned around and sold for the 28th of June. We sold a $125 call for $3.95. So right from the beginning, our net debit and our risk in the trade was $14.53, or $1,453 was our total capital tied up in the trade, and the most that we could possibly lose on the trade should it go completely against us. So keep in mind that we own a December 115, we sold a June 125. Here it is on 28th of June, and the stock traded up through 125 and a little below. Didn't want to risk an exercise on that, so we bought back that 125 call for June, rolled it out, sold a new call, a 125 call for July, 19th of July, and we were able to do that for $5 credit. So we took in another $500, and that $5 credit further reduces the net debit and our risk in the trade. It had been $14.53 originally. With the additional $5 for the roll, we've now reduced our current cost basis to $9.53, which is actually less than the width of the spread. So essentially we own the spread for less than its current intrinsic value. Now you might wonder, where do we sit currently on this trade? Should we decide to close it? Well, we said we reduced our current cost basis to $9.53. And if we look at the current price, here's NVIDIA. This is the closing trade. Should we want to close this position right now? And in that case, we would buy back the 125 call that we sold for July, and we would sell our long call out in December. Right now, about an $18.50 credit to do that. So where we sit on the trade, we own this spread for $9.53. We could sell it for $18.57. Currently sitting at a very nice profit on this trade, but we will keep it going and keep rolling out, collecting additional credits. We see that NVIDIA has pretty hefty implied volatility, up around 50%. So these are expensive premiums. These are expensive options that we're selling, and we're collecting a nice premium. Every time we roll forward with that, we've reduced our cost basis even further. May even get to the point where we own that spread for free prior to the December expiration. So I hope that helps understand this particular trade setup. Seems a little complicated perhaps, but it's really quite simple. We're just using a long call, a little bit in the money, further out in time as a substitute for owning the shares of the stock. And these big pricey stocks that are having stock splits, these trades can work particularly well after the stock split. So I hope that helps to understand this very powerful premium selling strategy. Feel free to comment or email me, Brian@thetechnicaltraders.com. Take care, everyone.